In this video, we will look at Google stock to see if shares are currently trading at a bargain opportunity or whether we should avoid investing in Google at all costs. In the last 5 years, Google has seen its revenue increase by 107%. Profits have slightly lagged behind this figure, but have increased by 95%. That said, it is completely outshined by the free cash flow growth of 163%. Notably, profits and free cash flow saw a hefty decline in 2022, which asks the obvious question: is it time to buy Google when there's blood in the streets? Immediately, I'm drawn to the profit margins. They are very respectable at 23%, although they have fallen by 6% in the last 5 years, which may suggest that the company is becoming less efficient over time. That said, the strong ROIC figure, or return on capital employed, has actually increased by 17% to 30%, and this is a remarkable figure indicating strong profitability. This floats above Google's 5-year average of 27%, and you might infer that Google has become more efficient, not less. However, this ROIC figure has been artificially inflated by share buybacks, in which the total share count is actually reduced by 7% in the last 5 years. This has subsequently pushed up the earnings per share figure by 108% to $4.59. Since share prices are typically driven over the longer term by earnings growth, this is a promising sign unless they see financial difficulties and can no longer prop up the EPS with buybacks. So, with falling profits, could Google become a risky investment? Well, the balance sheet does show that debt has skyrocketed by 226% the last 5 years. But when contrasted to the equity, the debt to equity ratio is only 5% in 2022. Google's financial strength is backed by their current ratio of 2.38 times and quick ratio of 2.22 times, which is a mouthful to say. Although both of these ratios have decreased by around 40% the last 5 years, they are still in a formidable financial position. But unfortunately, I can see one red flag with Google's balance sheet, and it could present a big risk for investors of Google's stock. Despite the consistency of the cash position and the growth of equity, which has fueled the improvement in the net book value of 26%, it does mean that Google trades at quite a premium to its assets on the book, meaning its current price to book ratio is actually trading at around 6.2 times, and this does appear unattractive compared to its 5-year average of 5.2 times. This isn't unusual, especially for a tech stock. That said, it does stick out. Google pushes a lot of capital into share buybacks, which reduces the equity on the balance sheet and obviously hinders this book value from increasing as much as it could. Given that Google is heavily reliant on search, this could be a big concern, as it might suggest that Google is unable to find appealing returns on its money elsewhere. On the other hand, we could also see this as a positive, because it means that Google is so focused on what it does best. Why would you want them sinking billions of dollars on other bets? That said, where Google is attractive is its price to earnings ratio. Google currently trades at 26.4 times its 2022 earnings, which is closer to its 52-week high than the low, and it is slightly above the US market average of 25.1 times. However, this is an extremely dominant business with quite possibly one of the most defendable moats in the world. You only have to appreciate how annoying it is to use other search engines to really appreciate this factor. Therefore, if I was an investor looking to purchase shares at close to the market average, it would seem like a fairer relative valuation to me. But shares of Google have recently fallen, which might mean there are some big ongoing concerns in the most recent results. In Q3 year to date, revenue growth has slowed down, but the business is more profitable than last year, with profit margins increasing to 24%. Free cash flow also appears to be soaring, with an increase of 40% in the last year. This looks good to me, so why are investors selling? Is there something that we don't know? It would appear that investors are heavily focused on Google's cloud. The revenue split shows that growth has slowed down, going from an increase of 39% in 2022 to only an increase of 26% so far in 2023. Investors are clearly looking towards the cloud as the next big profit driver in the business, and perhaps hope that Google's cloud can alleviate the risk of Google's over-reliance on search, especially when considering that whilst it has grown search revenue, growth has slowed to 6% in the last year. Although, when we annualize the profits year to date, Google is trading at a price to earnings ratio of 19 times, which is well below its 5-year average of 24.8 times. Based on a discounted cash flow valuation, using the annualized profits year to date and assuming the share count in 2022, I think a fair price for shares of Google is around about $120 per share. But perhaps you believe Google's moat will erode with fierce competition, and you're looking for a stock that could achieve similar results. Do I know of one? Well, yeah, watch this video next to learn about a stock with the most defendable competitive advantages.